Futures. Futures trading can be done in stocks and indices. Stocks means like Reliance, TCS, Infosys, etc. Indices means Nifty, Bank Nifty, Fid Nifty, etc. Example of future contract will be like Reliance September FUT. Here FUT means futures. September means the contract will expire by September month. Reliance means the contract is built on Reliance company. Stocks and indices, it will expire on every last Thursday of the month. If last Thursday is holiday, then previous day like Wednesday will be the expiry day. If current month is September, we will have access to next 3 months. Like if this is September month, so we will have access to September, October and November. So you can see here Reliance September FUT, October FUT, November FUT. Consider that the current market price of Reliance is 3000 rupee. If I think Reliance will increase up to 3100 by October, then I will buy Reliance October FUT. And if I think like Reliance will decrease by 2900 by October, then I will sell Reliance October FUT. So we can trade only in 3 months contract. So why we need a contract? The main reason of introducing the derivative product is hedging. Hedging means protecting. That means protecting our portfolio. For example, you have invested 10 lakh rupees in Reliance company. So there may be a bad news in the market like COVID-19, inflation, recession, war, crisis, etc. In this type of events, there is a high chance that market may fall, and so we need to protect our portfolio. So here what we do short selling. So as we know, short selling can be done only in intraday. We cannot do short selling in delivery. To overcome this problem, derivatives are introduced. So here you can see Reliance October FUT sell. Profit coming from the future is covered by the temporary loss from the Reliance stock in our portfolio which we have invested. Once entered in the futures, you can sell at any time, but we need to sell before expiry. That may be 1 month or 2 months, 3 months expiry. So derivatives are introduced for the purpose of hedging only, but we can use it for speculation as well. Speculation means buying the futures without having any portfolio stocks. Example like Reliance has posted bad results. Okay, so like there is a profit decrease, crude oil prices are increasing, something like that. So and if I want to take advantage of this, but I don't have any portfolio Reliance shares in my portfolio. Since I do not have any stocks of the Reliance, I can still sell futures for speculation without holding Reliance shares. Okay, so this one let us discuss in the trading platform. So this is Zerodha. So here I will be typing Reliance and you can add it here. You can see the current price of Reliance is around 2944. Okay, so here I want to buy Reliance FUT. So just type Reliance FUT. You can take anything, TCS, Infosys, anything, but I'm taking Reliance here. So I'm adding all these things. You can see here Reliance September FUT, October FUT, November FUT. This Reliance is an equity stock. These three are available. So we will not be having the December one because you know that FUT is available for the 3 months. Okay, and if vice versa, like Reliance is if you think Reliance will give good results, and you want to buy Reliance, which is better, stock or future? So this is the stock, this is the future. So which is better if you want to buy Reliance? Here you can see if in the Reliance share, if the one share is around you can see here. So if you want to buy one share is 2944, but consider example I want to buy 1000 shares. You need to invest 29,44,000 to buy 1000 shares. Okay, in equity you can buy 1 share, 10 shares, 100 shares, whatever it is. But in futures, if you see, you have to buy in the lots. Like one lot is 250, like 250, 500, 70,000. So previously when you see in Reliance, like each share is 2944 and her 1000 shares you need to spend 29,44,000. But you can see here in FUT future, if you buy 1000 shares, it will be around 5,23,000 only. So 5,23,000. Yeah, if you go for the October FUT next month, so it's 5,26,000 only. So futures contract is a leverage product. In futures, which contract is better? See, we have 3 options here: September, October FUT, September, October, November FUT. So which future contract we need to select? Okay, for that we need to see uh, we need to see two factors. First one is the margin and second one is liquidity. Let us see this one. If you see here, you need 5,23,000 in September, and for October you need 5,26,000, and for November you need 5,20,000. So margin is almost same. It's a difference of 3 to 4,000. That's not a big issue. And liquidity, see, you can see here, if I go with the September, you can see there are no gaps. Liquidity is good. There are buying and selling is happening. There are no gaps. And when you see for the October, this is also fine. Buying and selling is happening and no gaps. If you see November, see, there are a lot of gaps. Means buyers and sellers are not active, because if you buy 1,000 shares of November equity and when you want to sell them, there should be sellers. You can see these gaps. So its liquidity is very less. So better to avoid November, better to choose September, October. Since September is already going on, so we have only 2 weeks for expiry, it is better to choose October. So let us see what is the major difference between the equity and futures. See, equity we can hold it for long term, but futures we can hold it up to expiry. That is, whether you are buying September, October, November, we need to sell it by the end of the last week, that is on Thursday. So we use these futures for hedging and speculation.